Hi, welcome back to the Trial by Jennifer podcast series. Happy New Year. And I feel super excited. This is one of my dear friends and today's guest. Her name's Rachel Rhodes. She is a licensed mortgage broker in the state of Texas. And welcome, Rachel. Thank you so much for carving out time in your schedule to come and join me on the podcast. Tell us a little bit about who you are and what you do.
Well, my name is Rachel Rhodes. I am a Texas native. Um, I got into the mortgage industry in 2008, which was kind of like at the beginning of a major housing and economic crisis. And a lot of people are like, wow, that's a really interesting time to get into the industry. And I was like, yeah, well, you know what? Nobody was hiring. And I just graduated from college. And so I don't know, for whatever reasons, I decided that that was going to do. And I've been doing it now for the last 15 years. Um, Initially, I started working for major financial institutions in Dallas, um, more on the operations side, compliance and auditing side. Um, and then when I moved here to Austin, Austin is a very different niche. There's not a lot of major financial institutions here in Austin. There's more credit unions more than anything. Um, and there was also a lot of opportunity when it came to being on the front end and the retail side of mortgage. And so that's when I decided to go more into the retail side of loan originating when I moved here to Austin because that seemed to be the only opportunity available.
Mhm.
And so for the last 7, almost 8 years, is kind of what I've been doing. Um, Initially, I started off in residential and I have transitioned into commercial.
All
Um,
right, the big dogs.
yeah. And then now on to owning a brokerage.
I'm super grateful to have you on, and I'm excited to dig into all of this. But before we do, those of my audience members who listen to every episode probably, I don't know if they get sick of hearing me ask this or say this as like a preface to this question, but I ask all my guests this question. What was the conversation around personal finance like in your home growing up?
Like first time homebuyer financing?
No, like your own. So your own. How did your parents talk to you about money?
Wow. It's interesting because it was different between the way my mother's family um, worked around money versus my father's side of the family. So
Hmm.
my grandfather, my father's father, was a business entrepreneur and he owned his own grocery store. He owned various REO properties in
Mhm.
which he purchased cash at auctions through the city of Dallas. And
Mhm.
so having that background and having him and learning how to make um, you know, a dollar turn into $100,
Yeah.
$1,000, and to continuously doing the rinse and recycle process in order to um, build a legacy for his family before he
Mm.
passed away. My grandfather came from South Texas and um, you know, had a very good upbringing, very old school, traditional, but not, a middle class or upper class family. And so he worked really hard um,
Yeah.
to get to where he was at. So,
That's really neat. Thank you for sharing that. I love the South Texas flavor that you sprinkled in there. That really gives me a um, just salt of the earth picture. Um, and I just love that, the opportunity in America was alive and well back then. I feel like it still is, for those who want it. And so thank you for sharing that. And I was going to say before we get into like the state of the nation, yeah, so you came into the mortgage industry and housing market, I guess, right in 2008. Can you talk a little bit about what you've gathered in terms of the different factors that contributed to that housing crisis, and like, yeah, we'll kind of move into like regulations that were put into place, but I'm curious like what your perspective is on things leading up to the downfall.
Sure. Um, well, there are a few things that had happened. One, just based upon historical data, recessions usually fall somewhere between, it was every 8 years.
Hmm.
Um, and this time around, we were already due for a recession several years ago, just due to transitions between political parties and whatnot, kind of
Hmm.
had an effect on the um, pushing it further back, to say.
Yeah.
So that's one thing to take into consideration is that. Also, too, um, there were a lot of unethical lending practices at that time.
Hmm.
There were people that technically on paper were unqualified to be able to afford the mortgages that they were given.
Can you talk a little bit about what that looks like before we get into like what it looks like to be qualified, but what, yeah, can you kind of paint a picture of what that was?
Sure. And I can kind of give you a little, the example that I'm going to use is kind of
Hmm.
an example that can kind of somewhat still be applied right now because it's the exact same thing is happening. It's kind of interesting.
Oh,
So,
wow.
at that point of time between, I would say, 2004 and 2006 was a huge housing boom. And we had a lot of homes that were being built during that time. And so what happens is sometimes is that we have people that are first time home buyers that either financially don't have reserves to meet the requirements. They don't have the either the proper income per se to
Mhm.
meet their requirements, um, or they have not the best credit
Credit. Yeah.
that would qualify them as a real true qualified home buyer. And so what was being done was is that a lot of people were falling into non-QM loans. There were also other types of variations of loans that were being used in order to qualify the people. So some of them were like interest only loans, some of them were ARM loans that were being used. And in order to get around a loophole to make them qualified for the homes. And by doing that, sometimes you're setting up that person not exactly in a position to,
Be able to fulfill the mortgage, right?
right, because a lot of times armed loans and interest only loans will, in arms perspective, they only have a fixed interest rate for a certain amount of time. And during that time, the
Oh,
interest rates
no.
are outrageous. I mean,
Yeah.
a lot of people are complaining about a 6 to 9% interest rate. When I came into the industry in 2008, people
Wasn't it
were,
like 13?
it was 13, 15, 16%.
Yeah.
I mean, people were paying mortgages like they were paying interest on their credit cards. It was
Yeah.
crazy.
It's an arm and a
And
leg.
right. And so, because of that, people weren't going to be able to fulfill their commitment to their mortgage payments long term. And what happens is that a lot of people get into their homes and then they kind of forget about the long term obligation that they have to that mortgage payment. And so they end
Right.
up increasing their debt during that time. They go buy a boat, they go buy a new car, they go do all of these other things because they've got their dream house. And what happens is when you get into those particular types of loans, you're going to have to refinance into another loan. And if you've increased your debt, you no longer are going to qualify in
Qualify
order to refinance.
is
And
the
that
debt to income ratio.
Yes, and that's
Okay.
what happened. And not only that, but sometimes some people are under the assumption that, well, I've got the house, I've got the car and the boat, or whatever the case may be. And sometimes they end up falling behind on those payments because their first financial obligation is to maintain their mortgage. So even during that time, that's when their credit starts to get hit, which
Right.
ends up making them even more or less qualified from than when they originally bought the house. So sometimes people are not conscientious in terms of credit health after they get the house. And that sometimes ends up setting them up for failure. And that happened during that time. Now, another thing also too that happened during that time was that if you're putting less than 20% down on your home, you're
Mm-hmm.
required to have private mortgage insurance. And what happened was is there was a huge private mortgage insurance company that had went and had um, insured these loans, and how somehow in between that time had frivolently um, mismanaged their money so
Oh,
that
wow. So when everything started to default, or people went for
so when everybody
refinance,
started to defaulting, they
right,
were unable to cover those
the
loans.
claim,
Mhm.
right.
And so then that was where the beginning of that was the downfall
And then
from.
people lose faith in the market, and then the banks need bailing out. Okay,
Yeah.
so
So that insurance company got a bailout. Then the banks were in a deficit because of that. The banks
right.
had to get bailed out. And a lot of people were unhappy with the fact that um, the banks had got bailed out. Some people lost their homes during that time.
Oh
And
yeah.
the problem with that is that those financial institutions had to be built out because if the structure of those financial institutions fail, we wouldn't have been in a recession, but we would have been in a very long depression, which is
Either that, or I think that like it could have been like complete anarchy. Not to say that I don't want to be like an extremist or anything, but I think that the way that late stage capitalism exists today, and not to go, I'm a pretty moderate person, but I will just say like the climate that we're living in today with capitalism. After running some numbers, for the personal finance side, just to kind of see, okay, like where is the barrier to entry and like what is the purchasing power of a college graduate today in an entry level job or even like mid level management compared to what it was in the 70s, in the 90s, even the early 2000s before the first crisis, right? And so it's like, it's less than half the purchasing power, like when you're looking at the data around wage stagnation measured up with the increase in rising housing costs. And
Mhm.
so, and then once you're in it, it's like property taxes. And I mean, I think too, there's just this overarching theme of Americans not understanding credit and debt,
Mhm.
and the impact that all of these things have. It's like a revolving door.
Well, there's not a lot of education, I think. I think a lot of people are not informed. So like
Look at
going,
student loans, you know?
yeah.
I mean, I did not understand compound interest until I was about two quarter or like halfway through my 4 year degree.
Mhm.
And it wasn't even through a formal class. It was through a club that I had founded, and we invited a money coach from the Career Center to come give a 2 part lecture on personal finance, and she did an example of compound interest, and
Mhm.
it blew my mind. But it's like, some people think that's great with when it comes to investment, but those who are dealing with debt and compounding interest, that's very scary.
It is, yeah, because you think that you're borrowing money and that you don't take into consideration the interest rate that you're paying for not paying the balance off. And then accumulate.
Right.
I mean, just in such a short amount of time, I mean, the interest can double and triple, you know?
Oh, you're literally just servicing your interest,
Yeah.
and I think that's true even with mortgages, like for the first several years, depending on what you purchase it at and things like that. I mean, I think it just depends on the down payment and things like that. But it's really important to understand the amortization schedule of a mortgage and where, you can put money towards the principal
Mhm.
balance, and
Mhm.
just understanding this like basic terminology around financial literacy. And I think it's even less common for women to have this
Mhm.
knowledge, because I was just creating some content this week on how this year marks 50 years, since only 50, right? Since women are legally able to have a bank account.
Mhm.
And it's like, that's mind blowing to me. I mean, that means we couldn't sign for a mortgage, we couldn't own property, it's like we couldn't have our own credit. Um, and we were at the mercy of our husbands.
Mhm.
And so, yeah, I think that there is such a lack of education. I'm curious, kind of moving into uh, like what kind of impact that had. I remember because I was graduating high school at that time, and I remember seeing headlines of newspapers and on the news like hundreds of thousands of college grads can't find jobs.
Yeah. Mhm.
And then it was like I remember driving around in these like very affluent neighborhoods, and foreclosed
Mhm.
or like for sale. So can you talk a little bit about what kind of impact all of that had? I mean, I think from a broad perspective, a lot of people can see, okay, yeah, we bailed the banks out, but
What
I
happened?
mean,
That what
what,
happened?
yeah,
Yeah.
yeah,
So what? Okay. So what happened was, um, and I'll give you two different scenarios. So,
okay.
which kind of applies now. Um, so a lot of times, particularly new first-time homebuyers, they usually tend to gravitate towards new construction homes. One of the reasons why is because a builder has a huge amount of incentives.
Incentives, yeah.
And one of the things is that they usually provide a certain percentage that will cover the closing costs. And usually first time home buyers, they don't have a whole lot of money to pay their down payment in addition to the closing costs. So the benefit of using a builder is to have the closing costs covered. Um,
Hmm.
so what happens is that on new construction, when the title company pulls up the tax certificate and the lender receives the tax certificate, they go based upon that information that's received from the county. Now, when the county goes out and appraises the lot, um, it is based on unimproved because at the time there's not a home built on it, there's no structure.
Right.
So when people get into these homes, their property taxes are being calculated on
Just
unimproved
on the
housing.
land.
Yeah.
Yeah.
So then what happens is with Texas being in a retro, meaning that we're a year behind when it comes to property taxes. You have to wait, depending on when you close, can be anywhere from a year and a half to 2 years. So what happens is people are under the assumption, typically their first year, with their property taxes being based upon unapproved taxes, until the following year the county comes back and says, "Oh wow, there's a
Oh,
house up here."
Uncle Sugar's here. Like, hey,
And so then what happens is you have to wait a whole other cycle to go by. And then they send your property tax statement, not only to you that you get, and usually first time home buyers see it and they have absolutely no idea what it means. But a copy of that gets sent to their mortgage company. The
mortgage.
mortgage company that has an escrow account established will send a notice to the mortgagee or mortgager, the person that is borrowing the money, and will say, "Oh, hey, by the way, you have an escrow balance." And the person's like, "I don't know what that means." Well, that means your monthly mortgage payment's going to increase. And it's like double the amount that you were qualified for. And what happens is a first time home buyer is typically approved nearly almost to the very mark of not qualifying.
The hill, right? And you just
They
because you kind of
barely
qualify
meet.
for more house doesn't mean that you
Right,
should.
right.
Oh,
So a lot of
man, this is
times
great.
lenders will take you up to almost the 50% mark of debt to income ratio, which is like sometimes you can get a pass on like 49.99%, right?
Oh
That
my
means like
God.
you are basically capped. And so what happens is that if, let's say for instance, the first time home buyer purchases a home on new construction, then they get into the house, they bought a car, they had a baby, like, regular life stuff happened in between that time.
Right.
They get the statement that their escrow balance has increased and they're in a deficit and their mortgage payment is doubling. A lot of times they cannot afford it. They cannot.
Right. So
And so they end up trying to sell. Well, we're starting to see that now again, where people are not able to afford their current mortgage payments due to the increases in taxes or the tax rate.
hmm,
And they have escrow balances, their mortgage payments have doubled. And so they're unable to continue to make their mortgage payments, and they have two options. It's either figure out a way to continue to make your mortgage payment,
hmm,
because refinancing at this point is not an option if you
right.
purchased a home a few years ago,
Right.
um, and or sell your house. So the problem is that if you choose to sell your house, you are now competing with the potential of five other houses on your same street to sell. And because you bought new construction, they're all
Buyer's market.
they're all cookie cuttered homes.
Hmm.
You are having to compete with your neighbors in order to get your home sold. And so by doing that, decreases the value of what you purchased for your home, which now
Oh,
puts you in even more of a deficit.
oh my
It's a
gosh.
no-win situation sometimes with circumstances that happen that way. And it's unfortunate, but it does. And it seems to be like that may be what is in the process of happening. And in between that time, employment, uh, with inflation and recession, businesses start to tighten up. They start to lay people off. People start losing
Hmm.
jobs, which makes it even more difficult for them to make their mortgage payments.
Right.
Um, and that's kind of like how that's what that ball looks like when it starts to roll.
Wow. Okay. I'm so, because I mean, I was raised by a realtor for 30 years, teaches real estate. I've never gone and sat in any of her classes, but she's invited me many times. She's been trying to convince me to get licensed forever.
You should.
And I think that there are some things that you just can't learn from your parents. But it's so fascinating to hear it from a mortgage broker's perspective. And so, what I'm gathering, I mean, is not only there are cycles, right? So this is just like one like segment of
Hmm.
the cycle,
Yeah.
but that this has happened before. Now, according to your awareness, did was something this like catastrophic as like the 2008 housing crisis, had that happened before, or was this like unprecedented?
So, in 2008, the interest rates prior to 2008, we were kind of already in a housing bubble and kind of like inflation had increased, but nobody was
Mm-hmm.
paying attention to it. But and the interest, because the economy was in our mind was running really well. Things looked great. And so people were still buying, being consumers and stuff. And not really paying attention to the fact that the rates were increasing and that they seemed to be somewhat high.
And they
Um,
weren't even paying mind to that. Like, it's fine. We'll just refinance.
yeah,
They
people
didn't
just thought it
understand the
was normal.
magnitude.
Yeah,
Right.
people thought it was normal, and so with that, in addition to all of the um, things that happened during that time, um, what ended up transpiring in 2008 was the unemployment rate started to drop. Um, a lot of people that ended up losing out were people, unfortunately, that owned homesteads. And one of the reasons why is because um, during that time, people were, from what I saw, was that, I mean, things looked great. People had businesses, people had boats, people had cars, and, people that, like you and I, regular people, were starting to invest in investment properties. And
Mhm.
so, with that being said, it kind of like increased like the market and kind of kept it going
Mhm.
until it didn't work anymore. And so the
Right.
people that were the business owners that had overextended themselves with all of the extra things that they had added as assets, but also debts as well. During that time, they ended up having to lose their REO properties. They lost all of their other amenities, and the only thing that they were able to save were their primary homes. But in the process of doing all of that, um, their businesses failed.
Yeah.
And so, because their businesses failed, and a lot of business owners' businesses failed during that time, people like you and I that were employed by those people became unemployed. And then that's how the
Mhm.
unemployment rate increased. And then that's kind of also how those people lost out on their homes.
I see. So it's
Um,
trickle down, right?
it just trickled down. And
Yeah.
so there were a lot of homes that were foreclosed during that time. And a lot of people were able to work with the lenders, the major financial institutions, with moratoriums, forbearances, modifications. Um, During that time, the interest rates had dropped down to three. That this is how we got down to the 3%, um, because there was no other way to save the economy but to reduce the rates as low as what they were.
Perfect segue, because I think a lot of people are listening and maybe just getting exposure at this point to the conversation around interest rates, or maybe they have a really clear understanding about them. But I remember when I was just starting to get my feet wet in the personal finance sector, like everything started kind of converging and understanding how it all works as a system. And I remember being like, well, how do they fucking come up with the interest rates, And so, can you talk a little bit about the federal funds rate and how it works in the mortgage industry?
Mhm. The federal funds rate is driven by inflation. inflation is driven by federal debt. And if I do believe, during the 2000s, we were in a war during that time, if you don't remember.
Oh, I
And
remember.
so um, we were coming out of a war, and there was a lot of federal debt. And so the inflation during 2004, 2006 had increased, hence the interest rates. Um, and once that happened, um, was kind of like how everything else happened. That, and then there was a lot of unethical practices, which,
Mhm.
due to that, the government did place like the Dodd-Frank Act. Um, there were lots of things, the Patriot Act, there were lots of things like right after all of that happened to prevent that ever happening again, and to prevent mortgage fraud and protecting consumers and stuff like that. There were
Mhm.
so many things that were put into place so that that would never happen again.
Right,
Uh,
because I think at a certain point it becomes like, well, and I think you mentioned this, it's a predatory loan, like qualifying somebody who's not qualified to have a mortgage, or like who doesn't have an understanding of what this could look like for a consumer in 5 years or 10 years or 30 years, right? And if they make it that far, and it's like you think about the responsibility that's on the lender's shoulders, and I think also the realtor and the consumers too, to like know what they're getting themselves into. But I mean, I think that
well, there
people are
definitely
money
was.
hungry,
Yeah, there definitely was predatory lending practices during that time. In fact, if I remember correctly, I think it was like in Chicago, maybe there was a huge thing. So I don't know if you're familiar with the term redlining.
Oh
Um,
yeah.
so there was a lot of that going on, and
Mm.
what it was lenders were targeting certain areas and certain demographic areas, and also
Mhm.
uh, specific socioeconomic classes. And at that
Mhm.
time, there was no um, rules or regulations in regards to how much a lender could charge a person on origination.
Wow.
Mhm. So,
Mhm.
due to that, was kind of also a little bit one of the reasons that kind of like contributed to some of the people qualifying and to some of the loans that they ended up getting themselves into. And a lot of it
That's
had to do with them not being educated too.
that's so, yeah, indeed, very
It
predatory.
is, it's unfortunate, but yeah. Mhm.
I I'm really glad that you have such a shining code of ethics to come and talk about this stuff so openly, because I think that it's important that people understand the mechanics of this, and especially anybody who's considering getting into a mortgage or buying, that they have all of the tools and the information that they need to really understand the big picture, because I think it's a very enticing carrot that can be dangled in front, to the American dream and buying a home and getting in and owning your own property, and it's like, I think there's again this mentality, just the way that these people get their head underwater with debt and things like that, of like, okay, um, the instant gratification of like home ownership and this huge purchase, but not really thinking through, okay, if I'm qualifying for an FHA loan or something, and I've got less than, 10-20% of my down payment, and putting very little down, right? And having all the closing costs covered, all these things, right? So it's really important. It's a really important conversation. And I think that this is a good time to pivot into like the actual process of first time home buying. there are still a lot of folks today that feel like there's a huge barrier to entry with the market, and that, you know, costs are too high. And I think maybe the 2008 crisis and maybe what we're experiencing today might be contributing on some level to like the wary or like trepidatious.
Before we get on that, I wanted to
Oh,
also,
yeah, yeah,
yeah, just kind of like going off the question that you had asked me.
yes, let's
Yeah, in
finish.
regards to the feds and the interest rates and stuff, like
Yes.
currently now. So,
Mm-hmm.
um, we were just barely getting back in 2019. We were just barely getting back to where the rates were somewhere between 5 and 6%, which was kind of the average during that time. And we were just getting to a place of getting pretty comfortable out of that recession. And the housing market was somewhat slowly starting to pick up and stuff like that. Um, what happened was is that we ended up finding ourselves in a worldly event that affected everybody across the board, and everything was shut
Indeed.
down. And so, because of that, that kind of also kind of prolonged a little bit of us somewhat kind of going back into the cycle of the inflation increasing, us paying the federal debt off,
Mm-hmm.
and whatnot. And because of that happening, it prolonged the inevitable longer than what it needed to be.
I see.
Because we did want the interest rates to increase naturally during that time in order to pay back federal debt that needed to be recovered from the history prior to that, the bailout money, all of the things,
The war
the war up
effort.
until then, right? All of that, was still on the books that needed to be paid for.
Mm-hmm.
And so, slowly having a healthy economy, you do want to see it rise, but at a very slow rate, to where it's not a complete total shock to everybody out here in the world or to the economy. And we were moving in that direction, and things were starting to kind of like get back on track, and a very slow, steady pace. But what happened is that happened, and then it just kind of like changed everything. And
Mm-hmm.
so it definitely prolonged the inevitable. So then coming out of that, the feds are like, well, guys, we've still got this federal debt that we still haven't paid for.
And
And
it's
like,
actually increased quite a bit. I think it just recently, yeah,
we had to have the ceiling increased just so that we would not be in a like for real recession.
yeah,
And, well, I mean, which we are right now, but I mean, there's a possibility it could have probably either put us back where we were at in 2008 or even worse, because the federal debt was much more than what it was in 2008, I believe. And so because of that, the feds were like, yeah, well, we have to pay this off. And how are we going to do that? Well, we have to increase the interest rates. And the reason why we have to increase the interest rates is because for the feds to lend money out to the banks on such a low interest rate, they're not gaining anything back in order for them to pay down the federal debt. Well, the
mm-hmm.
federal debt is not only homeland debt, the federal debt also includes foreign debt. And if
Mm,
you are a country that cannot pay your debt to another foreign country, that's not a good place to be in, because you can find yourself in war. So
yeah,
it's crucial. It's a crucial part of our infrastructure that inflation does take place, that federal debt is paid down. A lot of people are not, they don't understand,
Yeah.
that whole process and the meaning and the purpose behind it.
Yeah, and how they fluctuate and what's driving those forces. I think people are just like, oh my gosh,
Yeah, and so
this
another
is
way
the
also
interest rate.
too is to increase the 10-year treasury bond, because by doing that is a way for the uh, federal government to pay off their debt much faster. So it's like,
Mhm,
if you invest in a 10-year treasury bond now for us to go ahead and take this money, we're going to
mhm,
give you a bigger yield. And
mhm.
so mortgages are actually not so much driven by the actual action of the feds increasing the rates. It's actually driven by two things: um, oil and the 10-year treasury bond. It
Wow.
has nothing to do with the actual interest rates. And those are because the feds can increase the interest rate and it have no effect on the mortgage industry. Um, Sometimes it does and sometimes it doesn't. Um, but the two things that drive mortgage interest rates are oil and the
The
10-year treasury
treasury.
bond.
Wow. That's
And
so
and the
fascinating.
interesting thing about that is I actually saw all of this coming when we came out of the
Of
ice
course you
storm.
did.
I know when we came out of the
Visionary.
ice storm. When was the ice storm? Like,
2021. It was the snowpocalypse, February. It
so
was the
2 years
day
ago.
after Valentine's Day.
Okay, so 2 years ago, everybody thought I
Yeah.
was a completely crazy person. Um,
Well, you are, and we still think that. No, I'm kidding.
so after the snow apocalypse in 2021, I went to the gas station and I was like, are my eyes like deceiving me? Like, what just happened here? I was like,
The
how the
gas
heck did the
prices.
gas price just like automatically like double? And right then and there, I was like, this is the beginning. This is the beginning. And sure enough, it was. The gas prices slowly increased, like rapidly, like within that year.
And
Uh,
then the housing market.
yeah, yeah. I mean, the writing was on the wall. What's interesting is that Warren Buffett actually bought a huge amount of stock in Chevron, like right when that happened.
Wow.
Hmm. Oh, yeah.
That is so fascinating.
Hmm.
I First of all, I think this has been one of like the most enjoyable podcast episodes. I think it also helps, and for those listening, Rachel and I have like 1 2 hour long conversations at least once or twice a week. So this is nothing new.
Yeah.
But yeah, I don't know. We talk business like a fraction of the time, but it's so nice to do it with like a script of questions. And I feel like I learn a lot from all my guests, but I'm learning an exceptional amount this evening. And I want to just double check. Is it cool to pivot to the next question at
Oh,
this
yeah,
point?
yeah, yeah. I just wanted to
Okay.
point that
No,
out.
I'm glad we
That
did.
that's how the interest rates this time got
Yeah.
to where we're at right now.
Well, and like that's a kicker. You were kind of keeping that one in your back pocket. You were like, no, this is important. We need to go back to the finish. Yeah, that's
Yeah.
super fascinating. I'm gonna run it as the clip for the teaser. But okay, so first time home buying. I feel a lot of folks, again, they're like, this is a high barrier to entry. Homes are too expensive to purchase.
Mhm.
And I think they do. They have like this, I guess, wary sentiment of getting into something like that, probably because they were exposed to the 2008 crisis. Can
Mhm.
you talk about what pre-qualification is and what that looks like with today's regulations?
So a pre-qualification is based upon your FICO score, and every investor is different. So FHA's FICO requirements is different from conventional, which is Fannie Mae, Freddie Mac. Um, and there are several different um, wholesaler lenders or investors that are willing to kind of take it down to the wire when it comes to qualifying for FICO scores. So they can sometimes take it down to like a 580
Oh,
on
wow.
on a FHA. They can take it
Wow.
down sometimes to maybe like a 600 on
Mm.
more of like a conventional. Um, because conventional is 420 and FHA is, I mean, not four, is 620. And then FHA, I believe, is 640. If I am quoting that
Okay.
correctly, I think so.
Okay.
Um, but yeah, and you can take it up to almost 50% debt to income ratio, but you'll also find some people that will do manual underwriting, which sometimes the debt to income ratio is over the 50% mark. But there are qualifiers um, that make it to where they can qualify for a manual underwrite. So, like, let's say, for instance, they're a first time home buyer and they have really good credit, um, but their debt to income ratio is higher than 50%. So,
Hmm.
sometimes you can get what is called like a refer, um, like eligible or approved, and that's considered to be a manual underwrite. And there are investors that are out there that are willing to do those. Now,
Is that like in the instance where there's different types of debt? Like, so maybe it's like student loan debt or like medical debt that isn't necessarily as
medical debt is never considered in your debt to income
okay.
ratio, those are automatically removed. Student loans are part of the debt to income ratio. And the reason why is because all federal debt has to be um,
Oh,
considered in the debt to income ratio.
okay.
You are behind or delinquent or in collections on any form of federal debt, that disqualifies you from getting a loan, a traditional one.
Interesting.
Mhm.
Okay. So, but is the manual underwriting based on that type of like where it prioritizes the debt
It
in
does.
terms of
Yeah.
risk? And so it's
Mhm.
like, okay, well, they just have student loans, they're current on all of them, there's no high interest rate credit card debt, and they're not like uh, I don't know, driving a Mercedes, working at McDonald's or something. I
Right.
don't know.
Right.
Right? So I'm just making stuff up, but okay, so it's based on they underwrite based on the type of debt.
They underwrite it based on the risk
Yeah,
of it, which
cool.
is usually based upon the liabilities that are already
Right.
pre-existing,
Yeah.
versus the
Okay.
income.
Okay. So okay, so then we've got that the debt to okay, so those are our two factors that pre-qualify. Now, when we're getting pre-qualified, so because I've spoken with a realtor on the podcast, and we've kind of gone that route of like doing the buyer's consultation and then signing a rep agreement, and then either going to look at homes or going to talk to the lender first.
Mhm.
But so say the person gets or couple gets pre-qualified. Now what?
Then they usually give their pre-qualification letter to their realtor, and then their realtor will try to find a home from them uh,
Within
within
those.
that purchase price amount. And usually they'll write the contract based upon the pre-qualification letter. So the pre-qualification letter will indicate what type of loan it's going to be.
Mm-hmm.
And usually that is part of the financing addendum and the real estate contract agreement.
Mm-hmm.
So if a person is pre-qualified for an FHA loan for a certain amount of interest rate for a fixed 30 years with a certain amount of a down payment, then that is typically what is duplicated on the real estate. If the offer is accepted, if the seller accepts the offer, that is usually what is part of the financing addendum on the real estate contract on the purchase agreement. And the reason why is because that's what they qualify for.
Yeah, right.
So,
I know that it's like, when it's a seller's market, for instance, like kind of what we saw here in Austin. I don't know the market data for everywhere else, but I know in 2021, Austin had an incredibly competitive sellers market. And so buyers, we were seeing homes go for like $100,000, $200,000 above the asking price and competing bids left and right. And you had to make an offer like as soon as the house was on the market, sight unseen type of a thing. So can you talk a little bit about, you've got your pre-qualification. They're out now with the realtor. They're narrowing down their homes. They find one that they like, um, and they're ready to make an offer. At what point, and obviously, hopefully, the realtor is guiding them through this process too, but just to give people kind of a pulse of like how those steps kind of unfold. So are they're ready to make an offer? At what point do they call the lender to get approved for the mortgage?
okay, so I think you're talking about two different things. So, in that scenario during that time, that was kind of a little bit, hold on, I have my heater on. Um, that that was kind of a little bit of an anomaly due to the
Yeah,
circumstances. Thank God, Texas was one of those states that, and particularly Austin, that was kind of not too much in adherence to completely like shutting everything down and having us housed in
right,
houses forever.
right.
And so, due to that, in order for the economy not to be completely halted or slowed, a lot of
People moved here.
business corporations were moving here,
Mhm.
and the benefit of them moving to Texas is for tax purposes because we have a state where it's the like right to work,
Mhm.
which is a benefit to business owners.
Mhm.
And not only that, but we don't have a federal tax. I mean, we don't have a
State
state.
income.
State, yeah, we don't have a state, federal, but not
Mhm.
state. So that's a benefit also to business
Mhm.
owners. So it was
Right.
very enticing for a lot of business corporations to move here to Austin. But not only that, a lot of people were just moving here in general because, well, we weren't completely shut down.
The tech
Uh,
boom too, that played a
right.
factor. And yeah, there were a lot of things.
Yeah, and so due to such a herd of people moving to the Austin area, even Dallas too, was a little bit overwhelming for the metropolitan areas, and so that's where you got into the bidding wars with.
Right.
Mhm. Um, that doesn't typically
It's not
happen.
normal.
It's not
Right.
normal. Yeah. But
But it is
now
kind of exciting. I'm
it
like,
is.
ooh.
Yeah. Yeah. It was. It's kind of exciting, but even that I have my own opinion about. But um, which is kind of also one of the reasons why the housing market is kind of a little slightly tilted here these days.
Hmm.
Um, but for a first time home buyer, I don't want first time home buyers to be discouraged from purchasing homes, even right now in the um, economic state. The interest rates are starting to fluctuate. The feds
Mm-hmm.
are in talks of slightly decreasing the interest rate.
Like three
Uh,
times, I think, is what they projected over the course of the year.
yes, yes, to kind of like revive everything up, kind of, going in and giving a little bit of heart resuscitation there for a
Come on, guys, buy, 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 right?
And so, yeah, I don't want first time home buyers to be completely discouraged from purchasing homes because even if the interest rates are high, which does cut into purchase power. So, purchase power is the purchase price amount, like the maximum purchase price amount that somebody can qualify for. Even though having a higher interest rate may not qualify a person for like the purchase price amount that they really want,
Mhm.
the goal is to own real estate in general.
I was
Real
gonna say
estate,
there's no time like time in the market,
right?
right?
Your dollar is more today than it is, yesterday.
Because because of
Or
investment.
yeah, yeah,
Yeah.
or tomorrow per se, like in
Hmm.
the future. So the
Right.
thing is that there's never going to ever be a good time to buy. Just buy.
Right.
If you can do it, buy. But be
And you
educated and wise about it. Because no matter what the economic state is, whether if the interest rates are high, but the housing prices are low, because that is something that we are seeing. So the prices of the houses have decreased since then, right?
hmm
So right now is a good time to buy, but the problem is the interest rates are really high. So people are like, well, I don't want to buy a house now, even though, my dream home is now affordable because the
you can
interest
always
rates
refinance when they go down. I know people are like, where, but you can. And it's like if you're
can.
as long as you're in a position where,
Yeah, you
you have
can.
to have some level of faith in the market also and just the economy.
Yeah. So here's my thing, what I usually tell first time home buyers, particularly younger people, is that and I know this to be true just with my own experience. So I bought my very first house in 2009, and I think I was 26, maybe around that age was when I bought my first house. And when I bought my first house, I was very conscious about how much I was buying at the time.
Hmm.
What I didn't take into consideration is that the amount of money that I was making that day or during that time was not going to be the income that I would continue to be making years later on down the road.
Hmm.
Obviously, with a younger person being at that age, there's always potential for promotions, growth, and expanding. And so, what your income is today, hypothetically, is not what you're going to be making over the course of 5 or 7 years later on down the road. Because on
Right.
average, people do move between 5 and 7 years from their first home that they purchase. They don't live in their home forever anymore.
You grow into the home and you grow into the mortgage.
Right. And a lot of people don't think like they don't typically think long term in that way.
Yeah.
So, one of the things is that if you can't afford right now in the market and what we're in right now for your dream home, just due to financial circumstances or whatnot, buy something because then what you can do is you can use the equity to then purchase your dream home.
Right.
Or you can use the home and turn it into an investment property,
A rental.
rental.
Yeah, rent it
Still,
out.
you can still use equity from that property
And
and
then buy.
buy another house, which is your dream home.
This has been my strategy from the get-go.
Yeah, and it
It's
works. People
brilliant.
people do it all the
It's how
time.
you break into the investment of real estate. I mean,
Yeah,
and then you keep it going. And then I a friend of mine, Dan, come on. Yeah, I think it was on like I can't remember which episode, but he has been doing real estate investment his whole life, like since he was a young adult, like I think 19 or 20. And he broke it down and he broke it down just the way you broke it down. And it just, you keep leveraging. And
Yeah,
then before you know it, that's your retirement. You're
it is.
going to the bank and or the mailbox and you've just got all these checks
Yeah,
that are coming in rent payments
yeah,
because you've paid off these mortgages and
yeah,
leveraged. And it's like now you've got a portfolio.
yeah.
Um,
Yeah, during 2021, I had a client of mine. I'll never forget her. She's the cutest thing ever, but she was super young. She was maybe 22, 23, somewhere around there.
wow.
Just graduated from like college, and she was buying her first home. And she was very super educated. I do have to give her that. But she was interested in buying a duplex
Hmm.
using
That's so
FHA.
smart. You live on one side and then you rent out the other.
Using FHA. So FHA is a minimum of 3.5% down payment. At that time, the interest rates were like 4% or less.
2.5% was what my student loan
Yeah.
at that year was. I was like,
I,
what? I
I
went
mean,
back and looked at it recently. I was like, oh my gosh.
yeah, I mean, I was just amazed by her. And she's like, yeah, she's like, I'm buying this duplex. By the way, it was like somewhere around downtown. And and she said, I'm going to buy the duplex, and what I'm going to do is I'm going to live in one unit, and I'm going to improve the other side of the unit, and then once that's done, I'm going to move into that one, and then I'm going to improve the other one. But somewhere along the line, she had this whole plan of like renting out one side and then moving into the, like going
Wow.
like back and forth, and it was just pure genius. And she ended up keeping that investment property, which was like the requirement time frame, for her to live in that as her primary home. She moved out, and then she ended up calling me like recently this last past year and was like, hey, I want to buy another house. This was going to be like her real house, and she was using the duplex that I helped her get into and purchase as collateral to help her
Perfect.
get into her real home that she really wanted to purchase. I mean, the girl did it right. And I mean, she was
She did. I bet she's gonna keep going. I bet you're gonna hear from
outside
her
of
like,
college. Yeah, yeah. And
yeah,
that's the way to do it. A lot of times, sometimes what happens is it's unfortunate, that sometimes with certain types of different socio demographics or socioeconomic classes, sometimes some first time home buyers are not first time home buyers until they're much older in age,
hmm,
um, like mid 30s or late 30s.
hmm,
And sometimes they're usually already at their prime when it comes to their careers and working and whatnot. And
hmm.
so um, there needs to be a little bit of education when you have a client, that is a first time home buyer at that stage, of life, with the age that they're kind of at. Not to say anything about their age in terms of qualifying or not, but
No,
it's
because we're not making any
no,
commentary on
no,
that specifically. You're just talking about the importance of education at later stages in life because, I mean, of the time value of money and looking
right.
at the um, the realistic approach to an investment property and also a first time home.
Right.
I totally get what you're saying.
Yeah, so like in the instance of the client that was much younger that had purchased that duplex home, let's just say, for instance, it wasn't a duplex home, it was just a regular single family home that she
Right.
purchased. Um, with her age being at what it is expected for her to continue to grow in her field of work and continue to increase income over that time.
Mm-hmm.
With a person, let's say, such as my age,
Mm-hmm.
um, sometimes you get to a point to where you're kind of already at your mark. Like that is probably the most you'll make. And there won't be any other additional like making more, right? And
Mm-hmm.
so sometimes putting somebody in a home um, with not the anticipation on having an increase in income,
Mm-hmm.
we have to also understand the dynamics of how everything works. Property
Right.
taxes are going to always continue to increase because the value of the home is going to increase. And
Right.
so that also needs to be educated and spoken of to the client and explained to them. So maybe
Right.
even though the person does qualify for this maximum purchase amount, like maybe educating them and saying, maybe you might want to not go all the way up to that amount and give yourself some wiggle room in between, um,
Mm-hmm.
for those life events, that are going to be expected to happen over time.
Well, and I think too, it's like hopefully if they are at that point in life that they're in their mid to late 30s per se, or just at uh that age with income, right? Where we're talking about kind of this like equilibrium when
Mhm.
we're talking about earning potential. Hopefully the reason they've waited this whole time is because they've really been saving, and so
Mhm.
they're putting forth, a lot um, more of an attractive like entry to the market.
Yeah, and not only that, but also too, at a certain point when you get to a certain age, just financially speaking, a lot of times with the difference between younger people and then people that are older is that they start getting to a place where they're having to start putting more money into their retirement,
Hmm.
and versus a younger person who is
Hmm.
able to kind of like stretch that out because they still have a lot more time. There's a lot of different things to take into consideration that I think a lot of people don't talk about with their clients when they're sitting down and going over the purchase process with them. And
Right, because it's a lot of paperwork.
it is.
And they're nervous about their qualification and then picking the right house because it's the biggest investment they're ever going to make,
Yeah.
and they want to make sure it's in a safe neighborhood, or, that the schools are good, or whatever their priorities are. Totally. This is really,
Yeah, and then also too, being there is an option which is called the buy down option, and
mhm,
usually it is available for newly college students. And the purpose of that is for them to start off with a lower interest rate, and then it gradually increases over the course of like 4 years or so. And the
mhm,
purpose is what we've been talking about, which is the anticipation of their income increasing. S-
right,
and then they get to like where they're based upon the terms of the buy down option. Once they get to that mark, then that's where their mortgage interest rate is going to stay for the duration of the amortization terms. But it's a gradual payment for them. Uh,
right.
Now that option is available, but it's not necessarily available to all. There are
Everyone.
right, there's
You
qualifications.
have to be, yeah. I think that's really interesting. I'm glad you shared that last part because I think, I would say that the majority of my audience is what I think most would consider like the zillennial generation. I think uh, I've seen 25 to 35, and it's a pretty even split between male and female. And then there's also a good portion that are 35 to 45. And I would actually say that's predominant, but they're like neck and neck. So, and it fluctuates. But I do think that it's important to hear those kinds of things. And I think also to anybody who is, you know, Gen X, boomers, maybe you've got kids and grandkids, right? And this is a great opportunity for them to look at ways to get into the market, right?
Yeah, so there were a lot of changes that were also made to the lending practices when it came to first time home buying. So before it used to be that both borrowers had to be considered first time home buyers. Um, and so that kind of excluded from family members, such as parents, being able to help their children purchase homes for
Oh,
themselves.
wow.
And so they changed that rule. So a parent is allowed to be on the note with their child and it still be considered as qualifying as a first time home buyer.
Now, is that true for spousal? Like if a spouse has owned a home previously, but then there is a like first time home buyer that is the other spouse, and maybe they want to qualify for one going in on having their both of their names on the deed.
I believe that both have to be
First
like
time.
yeah, first time
That's what I think too, but we'll have
the
to double
reason
check.
yes, what it is called as a non-occupant borrower.
I see. So it's
The
almost like
non
signing a promissory note.
right, the non-occupant borrower does not have to be a first-time home buyer, but the
Right.
occupying borrower does. And
Yeah.
so when it comes to having spouses on the same mortgage, because they're both going to be considered occupying borrowers, they both have to be first-time home buyers.
Well,
That's
and also, I mean, it gets kind of sticky with the communal property stuff, like in
yeah.
communal property states too. But Rachel, I just want to say thank you so much for coming on the podcast. Before we close, can you provide us like with one piece of advice that you might have for listeners in regards to any of these topics that we talked about today? If there's one thing they needed to like put in their pocket and take with them out into the world from you, what would that be?
Don't be afraid, don't be afraid. Don't be afraid of the unknown.
I love it.
Yeah.
Thank you guys so much for tuning in to the Trial by Jennifer podcast series. And I do hope that you will join me next week. I am interviewing the founder of the Financial Workout. And I just can't wait to go over some of the really exciting, important topics that we have to share with you guys. We're going to be talking about setting financial goals in the new year. And so that will be next Wednesday at 10 a.m. Central Time, as always. And we'll see you next week.